Welcome to Talk Tickers, your direct line to the heart of earnings calls. Today we're diving deep into Accel Entertainment's second quarter 2025 results. They're a significant force in the U.S. locals gaming market, but their latest report presented a fascinating mix. The big question for us today is Accel Entertainment, positioned for a breakout, or are they still sort of grinding through an extended growth phase?
That's a crucial question. For any company, especially one like Accel that's simultaneously pursuing growth initiatives and integrating major acquisitions, it's really vital to look beyond just the headline numbers. We need to dissect the underlying performance, scrutinize the strategic execution to really understand their trajectory.
Absolutely. So let's hit the headlines first. Accel reported a GAAP EPS of 0.08 cents. But here's where it really caught our eye. Their adjusted EPS came in at approximately $0.26. That's a notable beat, surpassing the consensus estimate of around $0.22 by a healthy 14% on an adjusted basis. Now, for those less familiar, GAAP EPS is their profit calculated under generally accepted accounting principles, while adjusted EPS often excludes one-time items or, non-recurring costs. To give a clearer picture of ongoing operational performance, the market often focuses on the adjusted figure for that reason.
Exactly, and that adjusted beat is a strong signal. It suggests operational efficiency and growth translating to the bottom line. However, it's not a completely clear picture. Revenue clocked in at $335.9 million, which just narrowly missed the consensus estimate of $337.6 million by about 0.5%.
Right.
It's like that slight miss. It still represents robust 8.6% year-over-year growth. So this dichotomy, a strong earnings beat on slightly lighter revenue, often leads investors to question the drivers of that profit beat. Are they just cutting costs, or is there maybe more to the story?
That's the core of our deep dive today. And digging a little deeper, we see some other positive trends. Adjusted EBITDA, for instance, which, remember, stands for earnings before interest, taxes, depreciation, and amortization. And it's often seen as a good measure of a company's core operational profitability.
Yeah, that hit a record, $53.2 million.
A record, right? Up a solid 7.1% year over year.
And their operational footprint also expanded. Locations increased to 4,427.
Up 3.1% year over year.
And terminals growing to 27,388. That's up 3.4% year over year. So growth is definitely happening.
All right, let's unpack the engine room then. Accel's core market strength and strategic expansion, their foundation, Illinois, remains their largest and most critical market. Revenue there hit a quarterly record, $245 million, showing robust growth of over 8% year over year.
Yeah, that's strong.
What's truly compelling here is the hold per day, a key metric in distributed gaming. It climbed to $910, a healthy 5.6% increase. That's not just more machines, that's more revenue per machine.
And that Illinois performance isn't accidental. It speaks directly to their strategic game enhancements and location optimization efforts really bearing fruit. We're seeing them effectively execute there. And a key development here is their TITO rollout. Ticket in, ticket out.
Right, TITO in Illinois started in July.
Exactly. While still in its infancy, the system promises to enhance the player experience and significantly reduce the need for cash handling at the field level, potentially lowering operating expenses too.
Okay.
Think of it as sort of an incremental margin lever that should become more impactful as deployment widens, boosting that operational efficiency we saw in the EPS beat.
Makes sense. Moving beyond the Illinois stronghold then, their Montana distributed gaming route saw revenue growth of 2.6% year over year. However, consolidated Montana figures actually saw a decline. Management attributed this mainly to timing on software sales from their wholly owned slot manufacturer, Grand Vision Gaming. Is that, a sufficient explanation, or could there be other factors like market saturation, maybe competition?
It's always worth digging into those timing explanations, right? Software sales can be lumpy. We'll want to see if that consolidated decline reverses next quarter. But what's perhaps more indicative of future potential are their developing markets, Nebraska and Georgia.
Ah, yes.
They showed truly impressive growth, up 26% and 54% respectively.
Wow.
This illustrates the payoff from their prior infrastructure investments in these newer territories.
So these developing markets are starting to contribute meaningfully to overall adjusted EBITDA. That's a good sign.
It is.
But on the flip side, Nevada revenue declined 7.7% year over year. Management pointed to the loss of a key customer back in Q3 2024 as the culprit. But they also quickly added that net of that customer, Nevada actually saw a slight revenue growth and improved margins by optimizing their operating footprint, pursuing higher margin locations. How much confidence should we put in that net of customer statement? Does it truly reflect a healthy underlying market there?
Well, that net of customer clarification is important.
Yeah.
But it also highlights the volatility, of relying on a few large accounts. It tells us they're being disciplined in optimizing their remaining footprint, which is positive.
Okay.
It suggests a focus on profitability even as they navigate customer churn. The challenge will be demonstrating consistent organic growth in that market going forward.
Right, the consistency. Let's shift to new strategic additions, often catalysts for future growth. The Toucan Gaming acquisition in Louisiana contributed approximately $10 million in revenue in Q2.
10 million, yeah. Adding over 600 terminals across nearly 100 locations.
Right, and management expects to realize additional synergies and improved EBITDA performance from this into next year. What are the key synergy opportunities there, and what are the risks?
The synergies usually come from integrating their operational expertise, leveraging their scale, optimizing the newly acquired locations with better games or technology, that kind of thing.
Standard playbook stuff.
Pretty much. The risk, of course, is that integration always has its challenges. Cultural differences, unforeseen operational hurdles, they can delay or diminish those promised synergies.
Sure.
However, the Louisiana market itself offers a significant tailwind. New legislation passed there,
Oh.
allowing for an additional video gaming machine per route location and additional machines at truck stops.
Interesting.
This policy change could be a major driver for future growth and densification in the region. It could amplify the Toucan acquisition's potential beyond just the existing assets.
Okay, so that's a potential upside. And then there's the highly anticipated Fairmount Park Casino and Racing project in Illinois. Phase 1 opened in April, just before the Kentucky Derby.
Yeah, good timing. Generated strong turnout, lots of excitement.
Management highlighted positive indicators across the casino, racing, sportsbook, food and beverage, all aligning with their internal expectations.
Which is good to hear, even if it's still very early days.
Right. They seem confident in its long-term contribution, though, expecting meaningful EBITDA contribution into 2026, especially bolstered by that long-term revenue-sharing agreement with FanDuel's online sports betting operations in Illinois.
That FanDuel partnership is significant. It's a recurring revenue stream, which de-risks a portion of the project's earnings potential.
De-risks, good point.
The challenge will be maintaining that momentum beyond the initial excitement and ensuring Phase 2 planning and execution are seamless. This project is a material investment, so its successful ramp-up is really paramount for their 2026 outlook. It's a prime example of their densification strategy, but at scale.
Okay, so we've covered the operational side. What does this all mean for their financial discipline and future growth levers? Looking ahead, the company reaffirmed its full-year 2025 CapEx forecast. That's capital expenditures, money spent on assets.
Right, CapEx.
At $75 million to $80 million. This includes roughly $39 to $41 million for legacy markets, $5 to $7 million for Louisiana, and about $31 million for Fairmount Park.
Covering Phase 1 completion and initial Phase 2 planning.
Exactly.
This forecast really highlights that 2025 is an elevated spending year, especially with Fairmount Park. But here's the crucial insight. After these major projects are completed, normalized annual CapEx is expected to return to a much more modest $40 million to $45 million range.
Okay, so a significant drop-off.
Exactly. It signals a disciplined approach to capital allocation. It implies that once these large growth initiatives mature, the company anticipates a significant free cash flow inflection point, because they won't need to pour as much capital back into the business for new projects.
That free cash flow potential is definitely something investors will be watching closely. Management also reiterated an active and disciplined M&A pipeline. In the highly fragmented local gaming market, which they estimate at over $15 billion nationally.
It's a huge market.
They're specifically focused on accretive, bite-sized acquisitions that won't stretch the balance sheet. Given this fragmented market, what gives Accel an edge over other potential acquirers?
Their competitive advantage in this M&A landscape is actually quite unique. It stems from their sheer scale, their ability to implement sophisticated technology via Grand Vision Gaming, and even their capability to manufacture equipment in-house.
Right, the vertical integration.
Precisely. This allows them to take a more holistic approach to these smaller, often below-the-radar assets. They're not just buying, they're optimizing, upgrading, integrating these acquisitions into a more efficient, higher-margin network post-deal. It gives them a clear path to improving margins where others might just see, operational costs.
That's a strong competitive moat. Makes sense. In terms of capital returns, Accel repurchased 0.6 million shares for about $6.7 million in Q2, bringing the year-to-date total to 1.6 million shares for $16.9 million. Suggests they see value in their own stock.
They do. And it's a confident move. It's supported by a healthy balance sheet, too, with net debt around $331 million and $392 million in liquidity, including $265 million in cash. The company has significant financial firepower.
Plenty of flexibility.
Yeah, this strong position allows them to comfortably support both selective M&A and ongoing shareholder returns through buybacks. Without compromising their growth projects, it really shows financial flexibility.
Okay. Despite all these positive underlying trends, though, the strong adjusted EPS beat, record EBITDA, strategic expansion, disciplined capital management, the immediate market reaction was, well, pretty modest. Shares closed up only 0.6% on the day of the call and traded up a mere 0.24% after hours.
Yeah, very muted.
This suggests that investors are largely taking a wait-and-see approach, wanting to see these strategic initiatives fully translate into tangible, predictable earnings.
That's precisely the sentiment. And if we connect this to the broader market, Accel Entertainment has actually lagged the gaming sector. The BJK ETF, a common proxy for the gaming sector, was up maybe 12-13% year-to-date and year-over-year.
Yeah, okay.
While Accel's stock was down 7% over the last year.
Down 7%.
So the market appears to be awaiting concrete proof. Proof of the earnings leverage from Toucan Gaming and Fairmount Park. To truly manifest in 2026, they need to show, not just tell.
Right, the classic show me story. So given that sentiment on the market, what are the absolute key catalysts for investors to watch moving forward? What specific actions or data points will move the needle here?
Okay, there are several critical catalysts to keep an eye on. First, continued TITO penetration and, crucially, a resulting uplift in key performance indicators in Illinois. Need to see that efficiency gain.
Makes sense.
Second, we need clarity and planning for Phase 2 at Fairmount Park, especially after the racing season concludes. What's next?
Okay, Phase 2 clarity.
Third, any additional small deal M&A, not just that it happens, but that it demonstrates successful integration and margin improvement. Proof of the playbook.
Got it. Show the integration works.
And finally, next quarter checkpoints on the growth trajectory in Louisiana, Georgia, and Nebraska. Plus clear stabilization in Nevada after that customer loss.
So monitoring those growth engines and Nevada.
Exactly. If these vectors land effectively, that anticipated 2026 EBITDA contribution from Fairmount Park and the Louisiana synergies, that could indeed be a significant valuation unlock for the company, help close that gap with the broader sector.
All right, now for a segment that is definitively not financial advice, but more of a thought experiment. If we were pitching an outrageous but plausible trade idea based on this earnings call, what would it be?
Okay, not financial advice. Given the market's wait-and-see stance on that potential 2026 EBITDA boost, and Accel's stated CapEx discipline returning to a normalized run rate after these big projects, here's an idea. A long-dated out-of-the-money call option spread on Accel Entertainment, ticker ACL.
Okay, unpack that a bit. Long-dated calls.
Conceptually, this means you're making a leveraged bet that the stock price will rise significantly. By late 2026 or maybe early 2027, you'd buy calls with strike prices, say, 20-30% above the current price, and simultaneously sell slightly higher strike calls in the same expiry to reduce your initial cost, your premium.
So betting on a big move up, but capping the upside slightly to lower the cost.
Exactly. This trade is essentially a bet that the market is currently underpricing the probability and the magnitude of that valuation unlock. The one from Fairmount Park and Louisiana synergies that management explicitly highlighted for 2026.
Right, the things the market is waiting to see proof of.
Precisely. It's outrageous because of that extended time horizon and the distance of the strike prices. It needs a big move, but it's plausible if Accel truly executes on its stated catalysts and begins to close that performance gap with the broader gaming sector. It's definitely a high conviction, high risk, potentially high reward play on future execution. Depends entirely on them delivering.
Okay, definitely a thought experiment there. So wrapping up, we've truly unpacked Accel Entertainment's Q2, highlighted a strong adjusted EPS beat, record EBITDA, alongside strategic expansion and disciplined capital management. Even if the market reaction was, well, somewhat muted, it's clear they're making moves.
Yeah, the takeaway for you listening is this. Accel is in a crucial execution phase right now. Their expand and densify playbook is active, but the market awaits concrete proof. Proof that these strategies will translate into tangible earnings power in the coming quarters, particularly as we look toward 2026. The groundwork is laid. Now it's really about delivering.
As always, this has been the Deep Dive, designed to give you the most important nuggets of knowledge without the information overload. Thank you for tuning in to Talk Tickers. And remember, the insights shared here are for informational purposes only. They are definitely not financial advice. We encourage you to always do your own due diligence.
Keep exploring, keep learning, and keep questioning.
We look forward to our next deep dive with you.